going to tell you the best upcoming ex-dividend stocks to add to your portfolio so that you can get that sweet dividend income. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please seek a licensed professional. The first stock is a technology stock that provides safety, health and environmental technology solutions. Halma is the lowest yielding stock of the video with a dividend yield of 0.71%, typically paying in February and October each year. They currently have a really low payout ratio of 34%, allowing them to continue growing their dividend and also reinvest a majority of the earnings back into the company. In which in the last 10 years, they've managed to grow their dividend by a compound annual growth rate of 6.78%. And this is actually combined with successfully having an excellent dividend track record in which in the last 20 years, they've grown it each and every year. And I believe that this goes up to 41 years of dividend growth. However, it could be unsustainable if they're unable to grow their earnings at a fast enough rate to keep up with their dividend growth. In fact, in the last 5 years, they've managed to grow their earnings by 13.3% on average each year, which means that not only are they able to cover their dividend, but they've actually got so much spare cash that they're going to either have to keep increasing their dividend rapidly, or the payout ratio is going to get lower and lower and lower, till eventually it feels like a very low risk stock. And this is combined with the fact that they have a great balance sheet in which their short-term assets outweigh their short-term liabilities and their short-term assets outweigh their long-term liabilities. This is also compounded with a low debt to equity ratio of 37% and the fact that it's easily covered by their operating cash flow. If you'd bought HLMA 5 years ago, you would have gotten returns of 200.6% with dividends reinvested, completely outperforming the market of 16.9%. This stock is going ex-dividend on the 27th of August, so you do have some time to build a position. The next company I believe is one of the best stocks in the market to diversify your portfolio and act as a hedge in times of uncertainty/volatility. And they make money from selling CFDs or contracts for differences. And this company, Plus 500, currently has a dividend yield of around 7.1% and typically pays biannually in July and November each year. They currently have a payout ratio of around 48%, which looks great. It means they can reinvest the majority of their earnings and continue growing their dividend. However, this could be unstable if their earnings growth is not consistent. And in fact, in the last 5 years, whilst they've had amazing earnings growth on average getting 24% each year, this has been a volatile ride. And this is because they are so greatly impacted by high regulations put in place against CFDs, such as the EU regulations, meaning that their earnings had dropped a considerable chunk. And with volatility of their earnings, this also means that their dividends can be unsustainable. And in the period of time that they've been paying a dividend, it has been very volatile. Yes, they'd grown it for the first 5 years, but then cut it in 2019, and then they've grown it halfway back. So it's very complicated. So you can't really rely on this income at all times. However, this is priced in with the high risk dividend yield potential. In fact, though, if you look at the compound annual growth rate of the dividend, they have still managed to grow it by 10.38% the last 5 years. But as I've said, there's no guarantee that this will continue. And please drop me one of these for the YouTube algorithm, as they've not shown true commitment to their dividend. However, despite this, they are in fantastic health, and their balance sheet means that their short-term assets outweigh their short-term liabilities and long-term liabilities combined. This combined with the fact that they've been completely debt-free for at least 5 years and possibly longer, and making them very likely that no matter the scenario, that they're very likely to survive the outcome and continue to be a business, such as a black swan pandemic event, which we're currently experiencing. In fact, if you'd have owned this stock in the last 5 years, you would have seen returns of 545.1% with dividends reinvested, once more completely destroying the market of 16.9%. Ex-Dividend is the 20th of August. 60% of you watching this video aren't subscribed, so please consider subscribing as it doesn't cost a penny and is free. Thank you. I suspect that this is one of the least known stocks on the list, and this is despite having such great returns in the last 20 years. This stock markets and sells chemicals across the globe. Croda currently have a dividend yield of 1.5% and a dividend frequency of biannually, typically paying in May and October each year. They do currently have a fairly high payout ratio of 58%, suggesting that they've perhaps done a lot of their growth or earnings growth already, and therefore perhaps their dividend growth could slow down in the future as it becomes higher amount of earnings. But at the moment it's in a good spot, but definitely on the higher end. So have their earnings been reduced in the last few years? Well, in fact, in the last 5 years, on average, they've only managed to gain earnings or increase their earnings by an annual compound growth rate of 5.3% each year, which is very low. And this is because it had slowed down and is now losing money. And the loss of money is very much due to the pandemic. But despite this, they've got an excellent dividend history, and in the last 20 years managed to grow it every single year. Not only this, but in the last 10 years, they've managed to grow their dividend by a compound annual growth rate of 13.78%. Although this would suggest that this is unsustainable if they're unable to successfully grow their earnings in the future. So is the dividend at risk? Well, Croda are in pretty good health. Their short-term assets outweigh their short-term liabilities, but their short-term assets do not outweigh their long-term liabilities. And it is concerning that over the last 5 years, they have actually increased their debt load and have subsequently gotten a lower cash position. However, this is very likely due to the pandemic that's ongoing and the uncertainty around it, and so it makes a lot of sense why the debt and cash would subsequently change. But this certainly puts this stock at one of the riskiest on the list, but perhaps this presents an opportunity to buy. And if you'd have owned this stock in the last 5 years, you would have gotten returns of 119.1% with dividends reinvested being the third stock on the list to completely outperform the market. The ex-dividend for Croda is the 20th of August, and thank you for watching. I'm Osborne Foreman. Have a great weekend.